Hey everybody, this is Greg Gossett from Gossett and Trading and Mentoring, and today is Saturday, April 6th, 2024. Hey, I hope you're doing well. I hope you had a good week, and I appreciate you coming to my weekend review podcast. Boy, it was quite a week in the market. Um, we kind of had a bit of a crackdown, which I was anticipating, but we'll take a look at the indexes later, and I'll kind of give you my analysis of what's going on here. But again, thank you so much. And the format for the podcast today is, first of all, we are going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades I made last week, both on the weekly and the daily timeframes. I like to trade multiple timeframes, and I'll get into a little bit about the pillars of my trading and the three overarching pillars of what's important to me in trading, and you'll see how those this week kept me out of trouble. But we'll talk about when I entered each trade, why I entered each trade, what was the strategy, what was the thinking, what were the confluences and the combinations of indicators that I saw that led me to enter the trade. And then most importantly, we are going to talk about how I am going to manage the trade going forward, whether it goes my way or against me. It's very important in trading that you have a complete process so that you know exactly what you are going to do, regardless of what the market does. Of course, if I enter a long trade, I want it to go up, but I have to be aware of the fact that it certainly could go against me. And honestly, as a professional trader, you should think first and foremost about the risk and if it goes against you. You know, I studied with Larry Williams, who was one of my first trading coaches 27, 26 years ago, something like that. And what he mentioned to me was very interesting, and it may sound negative, but I really understand what he was getting to. But he said, you know, when I go into a trade, I assume that trade is wrong every single time. And if I do that, then if it is wrong, I go, aha, I'm right. And there's no issue with his ego. If you go into a trade thinking, oh, this baby's going up, and then it doesn't going up, there's that chance that you may not follow your process or not follow your rules of getting out when you are supposed to. So it's a little bit of a trick, a little bit of a mental trick, but really that's what I do. I go into every trade going, this is probably not going to work. Even if it's the best trade in the world, it's probably not going to work. And so if it does go against me, I go, aha, I'm right. And see how it gets the ego involved. And if you think it's going to go against you and it does go against you, then it's much easier to get out than if you think, oh, this is the best trade in the world, it's got to go up, and it doesn't, because if it goes down, you go, oh, well, you know, it's going to go back up. And that's how you can get into problems. All right. So you got to have that process. You got to know exactly what you're going to do, regardless of what the market does. There's many things involved, and you know, in this podcast, I'm going to try to explain to you my process the best that I can, as far as, you know, if it goes against me, this is what I'm going to do. If it goes my way, this is what I'm going to do. If it gets at a certain level, this is what I'm going to do until I'm finally out of the trade. Okay, so we'll take a look at when I entered, why I entered, how I'm going to manage these current trades going forward, whether they go my way or they go against me. And you know, this was an interesting week. Like I said, we had a move down in the market, but it still was a good week for me, even though I did get stopped out of a bunch of my different trades, and that's because I had a variety of different types of markets. And so we'll go through all of that. After that, we're going to talk a little bit about trader psychology. It is the most important skill in trading, the ability to create that plan and following it, and create the plan and to follow it, and not to get distracted and not hold on to a trade that you're not supposed to. That all comes down to psychology, right? So I love to teach trading psychology because it's so important, and I hope it's helpful for you to hear it as well. After that, I have gone down through my watch list, my master watch list, and I'm looking at potential trades on the daily time frames and the weekly time frames. And I think I have some really good ones that I'm interested in last week. You know, I was hesitant to buy a lot of things in the past few weeks because of this major rally that we've had. And I saw a lot of red flags, mainly momentum flags, that kept me out of buying a lot of things. And I'm glad that I uh, did stay out of those, because we did have quite a change in the market this week, in the psychology of the market this week as well. But now I believe there are some good opportunities now that we've had a bit of a sell-off. So there are some markets, there are some stocks that are coming into some important levels, key levels, that you need to be patient and wait for, and that's what I have. And so they're not there yet. If they do get there, I'll consider taking the trade, but I want to see as many confluences and combinations of indicators and entry signals lining up, not just on one time frame, but on multiple time frames. And I think I have found some of those next week. But just because they get there doesn't mean I'll take the trade. I like to narrow down on the dailies. Even if I had 5 signals that happened on the same day, I would not take all 5. I would narrow it down to the best one, the one that had the most confluence of signals, the best risk to reward ratio, which one looked good, the best on multiple time frames, which one had the most relative strength. And so we'll go through those, and I'll show you what I'm looking for on the dailies. I think I have 10 potential daily trades for next week. And then as far as the weekly trades, take a look real quick. 3, only 3 on the weeklies. But I think they're good setups, and I'll show you them when we get to that point of the podcast. So hang tight. I'm going to run the U.S. legal disclaimer, and we'll get started in about 40 seconds after the legal disclaimer. Hold on. Thanks.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, thanks for holding on with me. And let's go through the current open trades that I have on the daily charts. And by the way, I'm going to show you here what my thinking is, what the strategies are. And if you would like to learn more about these strategies, I do offer a one-on-one course in the evening time via Skype. It's a 15-hour course where I teach my students all of my trading strategies, all of the rules. It's a great course. I've taught people from all around the world for many years, all the way from absolute beginners all the way up to hedge fund managers. So if you're interested in that, just contact me. My email is in the link in the description. I know you'll be a better trader after you've taken the course. Really, what you are going to learn is what I have developed over the last 28 years as a full-time trader. And then I'll talk a little bit more about it at the end of the podcast as well. Let's get started on RIO, R-I-O. I entered RIO all the way back here on the 29th of February at 61.78. You can see that I have a bar here that is marked in blue. This is called an abandoned baby. One of my new favorite strategies is an abandoned baby or a island reversal. And if you would like to learn more about those, I have a free video on YouTube. Just go to my YouTube channel and look for abandoned babies and island reversals, and I have a nice video there that explains. But this is an abandoned baby. This is only one bar. If it's more than one bar, then it's called an island reversal. But so here's the blue bar. The bar before it, we gapped down. So the sentiment from the close to the open was negative for whatever reason. But the very next day, it gaps up. So you have this everything's really bad to everything's really good. And what I've noticed is when you have this sudden shift in sentiment, it really does kind of color what's going to happen to that market in the future. So we gapped down, whatever the reason was, news was bad, and then we gapped up. Okay, that is called an abandoned baby. See how this bar has a gap to the left and a gap to the right, and it's just kind of hanging out here in space? Well, there's different ways that you can enter the abandoned baby. You can enter it right at the open, but I decided that, a lot of times gaps get filled. So it opened and then it came down to the high of the abandoned baby, or in other words, it filled the gap. See how he gapped up, but then it filled the gap. So I got long here, 61.78, and my exit process with abandoned babies and with island reversals is quite simple. Once I enter, I place a 2 ATR stop to the downside, which is the red line, and I place a 4 ATR stop to the upside. In my experience, the win rate on these is higher than 70%, which means if I take 100 of these trades, 70 of them are potentially going to work out, where I hit my 4 ATR profit target, and 30% of those are going to hit my 2 ATR stop. So on any one trade, I'm just not going to get really emotionally invested. All I can do is wait for a signal that shows me there's an edge that it's going to go upwards in this case, because it's a bullish abandoned baby, and then I place my 2 ATR stop below, so I know I have an edge that I'm going to make twice as much as I'm risking, and that's just good trading. Asymmetrical risks. Look for your edge, look for your setup that has an edge, place your stop, place your profit target on these particular trades, on abandoned babies and island reversals. On other types of trades, other strategies that I use, I scale out as the market starts to move my way. Then I tighten up my stop, more traditional type of trading. But these are more position types of trading. So again, we gap down, we gap up, we create an abandoned baby, we come down, we fill the gap. I know that's generally a good place to enter. I enter here 61.78. If it gets down to 59.51, I'm going to exit the trade for a 2 ATR stop. Comes up here to my 4 ATR profit, I will get out. And you can see it's been a wild ride. It's been up and down and up and down and up and down. And then last week we started really kind of starting to get close to the 4 ATR profit target. But then the last couple days with the market sell off, it's come down. But the good news, this particular trade still up from entry about 1.94%. So that's Rio. TLT. All right, so I have two TLT trades. I'll show you the most current open one, and then I did have one that I got stopped out on last week. And again, last week was a down week, so I did get stopped out of a bunch of my trades, which is totally okay. You're going to have hundreds and if not thousands of losing trades in your career, but the point is you need to keep the losing trades to a minimum, your percentage loss to a minimum. There will be times where you have more losing trades than you have winning trades, but you'll still be net positive because the winning trades make more than the losing trades. And that's really the key, and really the calculus math to trading is large wins, of course, totally fine. Small wins, totally fine. Break-even trades, totally fine. Small losses, also fine, also acceptable. But what you have to keep yourself away from are the large losses. And how do you do that? Well, you just have to have a process. You have to have a formula that shows you where if I'm wrong, this is where I get out. If I'm maximum wrong, this is where I'm going to get out too. So even in the worst case scenario, it's not a large loss. And I'll show you more of those as we go on. So this was TLT. Yes, I took this on Thursday. Why? Well, very similar to Rio, it had, in this case, it had an island reversal, a bullish island reversal. You can see we gapped down, then we had a 1 day kind of sideways, and then on Thursday we gapped up, leaving these two bars here floating in space. And exactly the same as with Rio, I waited for it to fill the gap on the day, which I did at 92.18, immediately bounced. So Thursday, right off the bat, I was positive, but then of course we had the employment numbers come out on Friday, which were very hot, and that caused the market to go down. So I am down on the trade. currently, about 0.85%, and the exit strategy exactly the same. I have the 2 ATR loss down below here. I have the 4 ATR profit target up here. So I will just let this trade run. I'm not going to get in and scale and all this kind of stuff, because with these island reversals and these abandoned babies, in my opinion, they're such strong indicators that I give them a little bit more room to breathe. So if I'm right, I make a little bit more money. And it's very important to have different trading strategies, different kind of exit strategies. And I'll talk a little bit more about that further in the podcast. Again, we'll get back to the 3 tenets of my trading. So this one down 0.85%. I have a 2 ATR stop down here. If it hits there, I just get out. That's fine. But if bonds do catch a bid and decide to rally up here, about 95.83 will be my 4 ATR gains. And that's important. Again, find an approach, an entry that gives you an edge and bias towards the direction you're looking for in this particular direction. I have a 2 ATR stop here, 4 ATR gain here. Over time, these abandoned babies and these island reversals tend more often than not to go the direction that I want them to go. So, if I take 100 of these trades, and 30% of the time I lose 2 ATRs, but 70% of the time I make 4 ATRs, well, that's clearly profitable, right? And that, in my experience, this is about the math on this. But on this particular trade, I don't know. We could continue down, and I take another loss here, but we shall see. So this one down 0.85%. So on the open trades right now, Rio up 1.94%. On the closed trades right now, TLT down 0.85%. Okay, let me see. I didn't want to make all these charts really, really busy. So this is not the charts. This is just a graphic. This is TLT on another trade that I took back here on the, oh shoot, I don't have the dates here because this is not my chart. But let me explain why here. The entry was at, I wrote myself some notes here. The entry was at 93.06. Well, why did I take this? Well, this big down bar here, this is called a order block. It's the lowest low before structure change. Here, the swing high was a structure change. And so once we took this out, now we change structure to the upside, which you can see it did work. But in the future, if we do come down to the top of that order block, most of the time that is going to hold as support. So as the market came down here, you can see we touched it, we held, we touched it, we held. This one went below it, it's still inside the order block, and then we rallied, so you can see the top of that order block of the blue bar here, that really did, the market really did find some support here. And then here on this particular day, which I don't have the day, I'm sorry, I did enter at 93.06. Why? Well, I had a V2 entry signal. So I had the confirmation that the price was supporting the top of that order block, and I had a V2. A V2 is simply an entry signal consisting of 3 bars. Bar 1, bar 2, you can see how bar 2 went below bar 1's low, and then bar 3 closed above bar 1's close. That is called a V2, and I use V2s and V1s so much in my trading. They're really the bread and butter of my trading. And if you would like to learn more about V1s, V2s, you really should just go to my YouTube channel, look under V1, V2 entries. They're great, great, great entries, and they make any trade better if you have a V1 or a V2. So I entered here at 93.06. Now, first thing, when you enter a trade, you should think to the downside. Well, the first thing I'm going to think to the downside is, what is my maximum allowed loss? Well, my maximum allowed loss is simply 2 ATRs below my entry. This is the red line here. Now, that's the maximum allowed loss. Where is my end of day stop? Well, my end of day stop is on a V1 or V2 is just a close below halfway the washout bar. You can see the washout bar is the second bar here in this V2. So I have this red line here. Any close below this low I'm going to get out of the trade. And that's ultimately what I did. Now, I have an orange line up here. This is my 1.5 ATR trailing stop level. If I get to this level, now if I have a close below previous bar's low, I'm going to sell half of my position, okay? And in addition, if the market moves my way by the value of 0.45 ATRs, then I take partial profits. I take 10% of my remaining shares that I have in that position off if from the previous bar's close it moves up the value of 0.45. If it moves up the value of 0.9, then I've hit 2, right? And then if I can hit 3. So I always set 3 partial profits for the next day based upon the close. So here at the entry, the close was about 93.06. I placed 1 profit target, 2 profit target, 3 profit targets every single day from the previous bar's close. And you'll see why in this particular trade that really worked out and mitigated the loss on this trade substantially. So I got in at 93.06. The next day, really I nailed it. It went up. I hit 2 profit targets. So I took 20% of the remaining of the shares that I had off of the position. Then we moved down the next day, moved sideways. Then we had a big move up. Again, I took another 10% of my profits off. So now I have taken 30% of my profits, 30% of my position off. I only I have 70% of my position remaining, right? Because I took 30% off. And then we moved up again, and then we had this huge day down last week on here where it closed below halfway of the washout bar. So I got out for a 0.58% loss, but can you see how important it is on the profits that I took, because it helped me to mitigate the loss. And then so I got out, and you can see the next day we gapped way down and went way down. So I was very, very glad that I got out and followed my rules, because closing below halfway of that washout bar there, statistically, it's more likely to keep going down than it is to go back up. And of course, that's why I got out. And then, of course, again, I got back in the trade on Friday, and that was the trade I showed you before. So TLT, loss of 0.58%. You're going to have losses. The key is you keep those losses small, and a loss of 0.58% is definitely small. Okay, let's go to UUP. Another closed trade. Usually if these are closed trades, they're losing trades, and this was a losing trade here on UUP. You can see the highlighted blue 2 bars over here. This is a bearish island reversal, because we gapped up, gapped down, and did it work? It certainly did. I didn't take this one, unfortunately, but this definitely would have hit my 4 ATR profit target to the downside. So as we came back up here on the 21st of March, we came up to the bottom of this island reversal. That was my short position, and this one didn't work out. I got short at 28.17. Because I'm short, I placed my 2 ATR stop above, my 4 ATR profit target below, and this one just didn't work. It just went up, went up, went up, and on this particular day here on the 1st of April, April Fools, I got out for a loss of 0.7%. So in the last few island reversals and abandoned babies that I've shown you, they haven't worked, but they don't always work, right? But the key is, if they don't work, you're losing 2 ATRs. If they do work, you're making 4 ATRs. And I got out, and then it's come back down, but that's just how trading goes. So loss of 0.7% on the UUP. And then Pfizer. Okay, Pfizer. Just want to point out here, this is an island reversal. Gap down, 1 bar sideways, gap up. And this one, as advertised, this would have got you the 4 ATR gain for sure here. But I did not take this trade. I took this trade here when we came down to the bottom of this fair value gap here. You can see the highlighted blue here is the fair value gap, the low of this bar, the high of this bar, and I got long here at 27 36 when it came down and touched the bottom of that fair value gap. Next day it went up a little bit, no profit targets. Next day went up. I did take some profit targets. My stop on this particular trade is just a close below the low here, this line here, and that's ultimately where I had to get out of the trade. But it did chop around here for about a week. It did not get up to my trailing stop level, but I was able to take a little profit here. I was able to take a little profit here. Then when we went down, and then on Thursday with the big market sell-off, I did have to get out for a loss of 2.51%. So that one was not fun, but again, the importance of taking partial profits when you have them mitigates the loss. So this is a loss of 2.51%. So on the closed out trades this week, loss of 0.58% on TLT, a loss of 0.7% on UUP, and a loss of 2.51% on PFE. So that was my largest loss there. And again, it was a tough week this week for longs, for sure. So let's go to the weeklies. And, I think the weeklies illustrate some important things. And, I was talking about my 3 pillars of trading. And really what that comes down to is I want to trade at as many different time frames as possible. That's number 1. So I day trade all day long. I trade dailies. I trade weeklies. I trade monthlies. Sometimes day trading works out well and your daily and your weeklies don't work. Sometimes day trading doesn't work out, but your dailies work. Sometimes day trading doesn't work out, your dailies and your weeklies work. But usually one of those time frames will work out, and that really helps. So number 1, I want to trade as many different time frames as possible. Number 2, I want to trade as many different strategies as possible. I don't want to just have one strategy, because that one strategy might work in one particular market condition, but may not work in others. So I trade 5 at this point, actually, up to about 7 different trading strategies. Why? Because I want to have all sorts of different tools for all sorts of different markets. And again, I teach these all to you in my private one-on-one course. And that's why it's so great. You learn so many different trading strategies, because there's certain market conditions where one works, but it may not work in another one. So you need to have different trading approaches when the market's going down, when the market's going up, when it's going sideways. See what I mean? Or if you're looking for deep bottoms or deep tops as well. So this is XLF, and you can see the losing trades that I had last week on the dailies, a bunch of those, I was not in them very long. And that's really one of the keys to trading, everyone, is you're going to be wrong all the time. But the point is, if you're wrong, you need to be wrong quickly. So I always say, be very impatient with your losers and be very patient with your winners. And unfortunately, most people want to do the opposite. If they have a losing trade, they want to just stick in it and they go, it's okay. It's going to go back up. And if they have a quick win, they're like, ooh, I want to take that. Why? Well, because it feels good. But it's the exact opposite of correct trading. You need to let your winners run, and you need to cut your losses shortly. So this particular trade, XLF on the weekly, these are weekly bars. Weekly bars happened on Friday. I have been in this trade for over a year. So if that's the case, it's almost pretty much guaranteed fact that if I'm in this trade for over a year, it has been a winning trade. And this certainly is a winning trade. But it's a good example of staying in winners when you're right, and when you're wrong, getting out quickly. I mean, most of my losing trades, not all of them, but a large percentage of them, I'm only in them for 2 or 3 or 4 days. And if I'm wrong, I am out. But if I'm correct, I can be in them for weeks or months even. And that is correct trading. So I did buy XLF all the way back here on March 24th, 2023. Okay, why did I buy this? I bought this at 30.71. It's 40.51. Why did I buy it? Well, this is a deep dip buy stocks trading strategy. And deep dip buys involve the 200-day moving average, the black line, the 250-day moving average, the purple line, the 300-day moving average, or in this case, 300-week moving average is the orange line, and then I also factor in the 30 RSIs. But so this is a deep dip buy stock trading strategy, and on this particular week, do you see how during the week we touched the 250-day moving average, the purple line, but we closed above it? Okay, that is my entry. So I got long here at 30.71. I position size correctly based upon the account of the dollar amount of my trading account and also the volatility of the market. And then I immediately place my emergency stop 2 ATRs below. That's my worst case scenario. But then that's called my emergency stop. But my end of week stop on this one would have simply been a close below the purple line, the 250 week moving average. And then orange line up here, we talked about trailing stop level. If we get to the trailing stop level, now I go into trailing stop mode, which just means that if I have a close below previous bar's low, I'll get out of half the trade. So got in at 30.71. Again, 2 ATR profit target below. If my end of week stop is a close below the 250 week moving average. If I get up to the orange line, then I go into trailing stop mode. And as always, if I move the value of 0.45 ATRs, right now it's 40 cents, from the previous bar's close, then I take partial profits. So when I entered here at 30.71, the next week it moved up. I did take some partial profits off. Then we had a week of sideways. Then we had another week up, nice week up, where I did take some more profits off the table. And I also got into trailing stop mode, which again means that if I have a close below a previous bar's low, I'm going to get out of half. Then we went sideways for about 2 months. Never had a close below a previous bar's low, so that kept me in the trade. And then here on the 23rd of June, I had my first close below a previous bar's low after reaching trailing stop level. I got out of half of the remaining shares for, what does that say? Okay, 6.36%. So nice little gain there. Then we had this month and a half rally up, which was nice, which was great. Took some profits on these big up bars. Then we moved all the way back down. And this was a very key close here, because on this particular bar, see how during the week we went below the 250, the purple line, but then we closed back above it. This kept me in the trade, thankfully. And then, of course, we've had this skyrocketing move up. So we had this huge week. The next week took some profits. This week took some profits. This week took some profits. And then we've just been grinding and grinding and grinding and grinding higher. Now, I'm anticipating that I will be out of this trade shortly, because you can see this thin blue line here. This is the 5 EMA. And once you get to the 5 EMA, okay, sorry, I had to hit the pause button because I had a phone call that I had to come in. But we have the 5 EMA. This is the thin blue line here. Right now we're at 76.54 RSI. One of the rules that I use in my trading is whenever I'm whenever I'm at 65 RSI or higher, if I have a close then below the 5 EMA, I'm simply going to get out of the trade. Well, this week, during the week, we closed, at one point we were below the 5 EMA, but we closed back above. Had it not closed back above, I would have exited the trade, which is fine with me because I've been talking about this trade for about a year, and honestly, I'm a little tired of doing it, and I'm sure if you listen every week, I'm sure you're tired of it as well. But it is a good example of a process that just kept me in and in and in and in. My opinions don't matter. All that matters to me is what the market is saying, and the market still is closing above that 5 EMA. So this has been a monster trade, up 26.20%. And sorry, I just realized I didn't finish on the three principles of my trading. So it's multiple time frames. Trade as many different time frames as you can: intraday, weekly, daily, monthly. 2, trade as many different strategies as you can. And right now I trade about 7. And number 3, trade as many different markets as possible. If you only trade tech stocks, well, they're generally just going to go together on any given day. And when we get to my trade here on CCJ, which is the next example, you'll see why that particular trade saved my entire week. And what is CCJ? Well, CCJ is Cameco Corporation, and they deal in commodities. So that's what kept me having a winning week. So many different time frames as possible, many different strategies as possible, and as many different markets. And when I'm talking about different markets, I'm saying getting outside of just equities, bonds, gold, oil, uranium, right? The dollar, currencies. So not just trading equities. And so as many different time frames, as many different trading strategies, and as many different markets as possible. Then you spread your risk over many different markets, many different trading strategies, and many different time frames as possible. All right, let's go back to XLF. So yeah, on XLF, still in the trade, up 26.2%, simply a close below the 5 EMA, and I will be done with XLF. All right, let's go to CCJ, which I was just talking about. All right, perfect example, perfect, great trade. And earlier I was talking to you about V1s and V2s. Well, this is just a perfect example of a return to value V2. Notice the green bar here, the green line here and the green bar here. This is what is considered the value zone. Most people like to buy above the value zone because anytime you're above the value zone, you're in an uptrend, headlines are good, everyone thinks everything is going great, but ultimately buying above value is not a good idea. What you want to do, in my opinion, is buy in value, sell above value, or buy below value, like a deep dip buy, and sell back into value. What a lot of people do is they buy above value, and then when it comes back to value, they sell, and then it goes right back up. So for a return to value V1 or V2, this is a V2, and again, this is something I teach in my course, and I have another intraday trade, perfect return to value trade that I'm going to share with you after we go through the weeklies. Is the first thing you want to do is you want to be above the value zone. So here's the green line. We're certainly above the value zone. We want to wait for it to come back into the value zone. So here it comes back into the value zone. But the next requirement is we need some sideways motion. We need to show that there's some equilibrium of buyers and sellers. If there's an equilibrium of buyers and sellers, then things are going to go sideways. So that's what I'm looking for. So again, close above the value zone, come back into the value zone, look for sideways motion. Well, here you definitely have sideways motion. And then what was the entry trigger? The entry trigger was a V1 or a V2. That's why it's called a return to value, V1 or V2. This is a V2, bar 1, bar 2, bar 3. Bar 2 goes below bar 1's low. Bar 3 closes above bar 1's close. So I got long here at 42.80. And again, go to my YouTube channel, look for my video in the lessons playlist, V1s, V2s, and I have about a 40-minute or an hour video exactly on this. This is a perfect example. Return to value, sideways motion, V2 entry, bar 1, 2, 3, 2 goes below bar 1's low, bar 3 closes above. I got long here at 42.80. So I get long at 42.80. I position size correctly. I place my 2 ATR stop below. That's my maximum allowed loss. If it gets there, I lose 1%. And then again, I always have 2 stops, right? Emergency stop, and I have an end of day stop, or in this case, end of week stop. And again, halfway of the washout bar, if it this is the red line here at 40.80, if it closes below here, I am simply out of the trade. End of day stop, emergency stop. 1.5 ATRs above is my trailing stop level, and so when I got long at 40.80 the next week, it didn't do much. was almost completely unchanged, but it did hold above my end of week stop here. But then this particular week, huge move up. So I did take off a couple profit targets into this strength because look, right now the 0.45 ATR is 171. So anytime it moves, well, okay, I should say this, because this is real time. 49.21 is the closing price. I take 49.21, I add 171 to it. That would be my first profit target next week. I'll take my first profit target, add that 171 to it again. That will be my second profit target. I'll take my second profit target, add 171 to it again. That will be my third. That's what I do every week. I change the limit orders. I change the profit targets every single week. So you can see back last week when it was 43.32, at that time it was 160. So I added 160 to it. That was my first profit target. First profit target, added 160 to it again. That was my second. And then I added the second again, added the 0.45 to the second again. That was my third. And as you can see, I did hit 2 profit targets last week. So I took 20% of the position off. I have 80% remaining. If it goes tumbling down next week, it mitigates my loss because I locked in those profits. Market can't take it away from me. I'm a huge fan of playing offense and defense in your trading. Defense, what's defense? Defense is your end of day stop. Defense is your emergency stop. Defense is if you get in trailing stop mode and you have a close below previous bar's low. Everything is defensive if it goes against you. So if it goes against you, it's defensive. If it goes your way, it's offensive. And so that's why I think it's very important in trading that you play offense and defense. So this particular trade doing very well. Up 13.15% on the week. So I had a huge trade on that. As you can see, that saved my week because last week the market went down. I got stopped out of 3 or so of my daily swing trades. But for small losses, I think the largest loss there was 2 point whatever on Pfizer. The other one was 0.7. The other one was 0.5 something. So that is a good example of, yes, you're going to have losses, but keeping them small, which I did, and then trading a different type of market. If I would have been completely in equities, well, this would have not happened, right? So me getting outside of equities into commodities, that's why I had this big gain here, because they had big weeks. So that's the importance of placing your bets over many different time frames, many different markets, and many different strategies. So this one up 13.15%. All right, LMT. LMT is a short position that I have here. Why? You can see the highlighted blue area. So here we have a high. Here we make another high. On this particular bar here, we go down sharply, break market structure to the downside. So therefore, if we break market structure to the downside, if we come back up into this order block, see this top bar here, the bottom of the bar, the top of the bar. This is going to be the resistance area where more than likely from this point, it will head back down. So I did get short here at the end, during the week at 456.30. Okay, I have my trailing stop level 1.5 ATRs below. I have my end of week stop, which just simply if we go above this high, we close above this high, then it changes the structure. I'm out, and then I have my 2 ATR emergency stop over here. So I know exactly what I'm going to do next week. If it closes over the top of this bar next week, I'm going to get out. If it gets to my 2 ATR stop level, I'm going to get out regardless of whether it's the end of the week. It just gets there, I'm out, and I lose 1%. If it moves down, right now the value is 0.45, ATR value is 5.29. If it moves down next week at any point, 5.29, I'm going to take a profit target off, lock in those profits, reduce my position. If it gets down to my trailing stop level, then I'm going to go into trailing stop mode, which, because this trade is short, if I have a close above a previous bar's close, then I will exit the trade. So I know this all sounds complicated. It's really not. Like I said, in my one-on-one courses, I teach you exactly step by step by step how to do this. And then once I teach you, you have to show me that you understand it. We go through many different charts. We go through many different trades, and you're driving. You're showing me what we're doing on each bar. That's really one of the best ways to learn. So this particular trade, a little bit in the money, not much. Up there, about 0.19%. So basically break even at this point. But here's the trade. Again, we had a market structure break. We have an order block. We came back to the inside the order block, which means somewhere above this low and below this high. That's why I got short here. Again, if it closes over 462.87 next week, I'm simply out of the trade. So I know exactly what I'm going to do with this trade, regardless of what the market does. And that's what you need. You need a plan, whether it's trading or life or anything else. All right. And then last trade is Johnson & Johnson. Okay, I got long Johnson & Johnson back here on the 15th of December. Why? Well, this was a deep dip buy. And black line here is the 200 week moving average. This particular bar during the week went below the 200 and then closed back above it. It rejected the 200. That's what I wanted to see. In addition to that, we have a V1. We talked about V2s today, but we had a V1. Bar 1, bar 2. Bar 2 goes below bar 1's low, but yet closes above bar 1's close. So it rejected the area down here. That's good information to have. It's showing you, at this moment in time, we don't want to go much lower than here. And in addition to that, we did reject the 200-day moving average. So I did get long here at 154.27. My end of week stops are closed below the 200-day moving average. My emergency stop is 2 ATRs below. My trailing stop is 1.5 ATRs above my entry. And so I took the trade here, 154.27. We moved up for a couple weeks really, but not enough. Then we had a big up bar here. So what do you think I did there? I took some partial profits because it moved more than the value of 0.45 ATR. So I took some profits off the table. Next week went up again. Got to trailing stop level, which means now if I have a close below a previous bar's low, I am out of half the position. That happened here. You can see we closed below this bar. I got out with a gain of half the position with a gain of 3.33%. These numbers are off a little bit because of the dividend that came. But at that point, I did take half off for a gain of 3.33%. Then we had a few weeks of moving sideways, another big bar up where again, I took some more profits, which is important because this ended up with the remaining shares being losing trade. So again, the offensive part was smart. And then we moved down. Last week, we had a move up here. So in this move up here, I took more profits off at profitable levels. And then this week, we closed below the black line. We closed below the 200. That was my exit for a loss on the remaining shares of 1.18%. So you can see, though, this trade ended up being positive for me. Why? Because of my process, because of taking profits when I had them, having rules with a trailing stop level. This is what guaranteed me the profit in the trade, right? So taking profits here, getting out of half of my position here. And yes, the remaining shares ended up having a loss of 1.18%, but overall, the trade was positive. Okay, so real quick recap on the weeklies. XLF up 26.2%, CCJ up 13.15%, LMT up 0.19%, and J&J down 1.18%. But again, you see how important it is that I have losing trades, right? But the losing trades, most of the time, thankfully, most of the time, they are small losses. But as you can see, every once in a while, I'm going to have some really big wins, like the CCJ and the XLF, that pay for all those little losses and more. I want to show you one more V1, V2 here. I shared this on Twitter, but I was talking about the return to value V2 on CCJ on the weekly time frame. Well, this is the 5-minute time frame. This was a day trade that I had on WBA. It's Walgreens return to value V1. Well, look at the green line here, green line here. This is the value zone. Were we above the value zone? Yes, I don't want to buy above the value zone, but we came back to the value zone. That's the requirement. First requirement, you're above the 180, you're above the value zone. 2, you come back into the value zone. 3, you have sideways motion, which we certainly did. And 4, you have a V1 or a V2 entry. Well, here's the V1. Bar 1, bar 2. Bar 2 goes below bar 1's low. Close is above bar 1's close. My end of bar stops is simply a close below halfway the washout bar. Washout bar is right here, halfway. But look at that. It immediately moved up, 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 up. I exited here because we got above the 70 RSI, went below the 70 RSI, and we closed below the 5 EMA. So that was my exit. So it was a gain of 0.9% in 25, or I think 55 minutes. So really nice trade. But another example of not chasing stuff up here, waiting for it to come into the value zone, waiting for it to consolidate, waiting for a V1 or V2 trigger. This was a V1. And look how nice and easy that trade was. Okay. Let's get back to here. All right, before we get on to next week's trades, what I'm looking at, let's talk a little bit about trader psychology. I know this podcast is going a little bit much longer than normal, but I had a lot of positions and a lot of things to say. This is from Trading Composure. Great, great, great feed over on Twitter, over on X, at Trading Composure. Boy, he really goes deep on trading, and trading is deep. So I would really recommend you following his channel. Shift your focus from recouping losses to trading effectively. Maintain this mindset consistently for long-term success. Don't focus on making back your losses. Focus on trading well always. And, I mentioned a couple podcasts ago that I had a friend of mine who was really getting beat up in the market. And this is essentially what I shared with her. If you're in this boat, if you're having issues with your trading, if you're having a large drawdown right now, sometimes you think, what do I do? Do I quit? Do I take a break? Those are options as well. But I think what Trading Composure here says is very pertinent and is very, very good advice. Shift your focus from recouping losses. Get out of the mindset of, oh, I just have to make this back. I have to make this back. Usually doing that will have the opposite effect. What he says is maintain the mindset maintain this mindset consistently for long-term success. So shift your focus from recouping losses to just trading better, trading well. Don't think about your losses. Don't focus on making back your losses. Just focus on trading well. What does that mean? Being more patient, waiting for good setups that have good risk to reward ratios, position sizing correctly, knowing where your emergency stop is, and following that process. Don't even think about trying to make back. Just focus on following your process and trading better. Don't focus on making back your losses. Focus on trading well always. It's really good advice. It's really good advice. And if you don't have a process, find a process. You can study with me. You can study with other people. But the key is looking for a process that you're patient, waiting for good setups, multiple confluences of indicators, good risk to rewards, and having asymmetrical risk to rewards, so that if you're right, you can be right big. If you're wrong, you're going to be wrong small. That is the key. This is a great post, and I was excited to share it with you. And so if you are in that position, don't focus on making it back. Just focus on trading well. And if you trade well, that's how you make it back. All right. So, okay, let's get over to trades for next week. And again, I just want to mention that these markets are not where they need to be yet. If they were, I maybe would have already been in the trade. But it's nice on a Friday night. I usually do this on Friday night. I go through my entire watch list and I look for markets and I look for levels and go, gosh, you know what? If it got to that level, then that would be interesting. And so this is what I'm showing you. So here I have 10 symbols. Theoretically, all of them could trigger on Monday, but I'm not going to take all 10 trades. I'm going to narrow those 10 trades down to the very best one. And how do I pick the winner? Which one has the most confluences of signals? Which one has the best risk to reward ratio? Which one looks best on multiple time frames? Which market has the best relative strength compared to the rest of the market? That's what I do. It's like a treasure hunt. I narrow it down to the best candidate. And again, this is what in my trading course, this is what I will teach you to do as well. So let's start here. These are dailies on ARC. Well, no trade here, but look down here. Black line, 200-day moving average. This thicker gray line here, negative third ATR channel. This is a good level. I don't know if it's going to get there, and if it doesn't get there, I won't consider taking the trade. But if it does get there, I will consider taking the trade. 92% of prices when they get to this negative third ATR channel stop going down or go up. That's good information to know. 200-day moving average, the black line here. This will probably bring in institutional buyers, and it gives you a good construct of a trade that, hey, if it rejects the 200 and then closes back under the 200, I'm simply out for a small loss. If I'm right and it has a big move back up, that's how you make money in trading. You're going to have lots of losers, but you got to have those big winners. And buying at a negative third ATR channel with the confluence of the 200-day moving average, maybe we get down here or a 30 RSI as well. That would be a good risk to reward ratio. So that's what I'm looking for. And I drew the green line here at the 200-day moving average. I was talking about trading multiple time frames. Let's go over to the weekly time frame and see where that 200-day on the daily lines up. Well, lines up right here about the negative 1 ATR channel. That's a level, right? So it's giving you some supporting levels on the higher time frame. So next week, if we come down to the 200-day moving average, I will consider getting long ARC. Boeing, BA. Okay, well, there's no trade at the moment, but what I am looking for is a test of this low. Do you see how at this low we have deep red MACD bars? Well, I can already tell that if we come down to this, meet this low, we possibly won't have any green bars whatsoever, or red bars whatsoever, or if we do, they're not going to be very deep. They're not going to be as deep as over here. What does that mean? All that means is this move down here from a MACD momentum perspective does not have the strength as this. It basically means you're running out of sellers. And if you run out of sellers, the implication is you will go up. So that's what I'm looking for. It's not there yet. First thing I need to do is I need to test this low. And if it tests this low, then I still need an entry trigger like maybe a V1 or a V2 or an under 30 over 30. So I know a lot of bad news with Boeing, but from a chart perspective, I can tell this is running out of sellers at the moment. So I'm looking for a test of this low and then some kind of entry signal because of the double bottom bullish divergence it will have at that moment. Anheuser-Busch, Budweiser. Okay, well, this one's pretty easy. Just looking for this 200-day moving average here, the black line. You can see I was going to buy it down here, never touched it. So I've been looking to buy Budweiser, but I never got down to the 200. But if we do get down to this 200, again, we most likely will be testing these lows. And again, we will have a double bottom and a bullish divergence. You can see we're getting close to testing that low. We don't have any red bars. So there'll be a double bottom bullish divergence showing that you're running out of selling momentum and you're getting to a key level like the 200-day moving average. So this is what I'm talking about when I talk about looking for confluences, combinations of indicators. Test of the 200 by itself is good, but a test of the 200 in addition to having a double bottom bullish divergence is better. FedEx. Okay, FedEx, this is a short trade. Why short trade? Well, we've changed structure. We had these highs up here. Here's the swing low. Last week here on the second, we came below this low. This changed market structure to the downside. So if the market structure to the downside, this may just keep continuing to go down, but if you're in a downtrend like this indicates now, then what you want to do, at least what I want to do, is short rallies. Well, where's the level that I would get short? All the way up here, 286. This is the top of the fair value gap. The bottom of the fair value gap is the bottom of this low to the top of this high. That's why I shaded it in blue. Theoretically, anything in this blue area is legitimate short. You can see as soon as we got back in, we came back down. But I want to have a really good risk to reward ratio, so I'll just be patient. If we come back up to 286, I will consider shorting, and then my stop will simply be a close above this high with my 2 ATR stop above there. So I don't know if this is going to happen, but if it does, I will consider getting short FDX at 286. IBB. All right, well, IBB has kind of taken it on the chin over the last month and a half, clearly. So I'm looking for a potential long. Potential longs. Look at all these major moving averages down here. 300-day moving average, 200-day moving, 250, 200-day moving average. And if we get down to this level here, we'll be in the 30 RSI level. This is called a deep dip buy. And by the way, if you're not in the financial position to take my one-on-one course, I have a great online course on udemy.com specifically for this type of trade, the deep dip buy stock trading strategy. It's very affordable. It's 9.5 hours long, and you will learn step by step how to trade deep dip buys. And this is what I'm showing you right here is a deep dip buy trade. Just go to my YouTube channel in the description. The link is there. I've sold so many of those around the world, gotten so many reviews. I think I have like a 4.8 stars on that particular course, and it's very affordable. It's somewhere between $15 and $40, depending on the day. But boy, do you learn a lot from that. So, all right, back to IBB. This makes sense at this level, the 250, the 300, and the 200. I drew the line here at the 200. Let's look on the weekly chart. Does that line up with anything on the weekly? It does. Lines up with the 50 SMA. That's showing you potential support levels on the daily and support level on the weekly. That's better. It's better to have support level on multiple time frames than just one. So that's what I'm looking for. But again, it's going to have to come down here, either reject the 300, 250, or 200. And ultimately, ideally, rejecting the under 30, over 30 as well. But that's a good location. That's what I was telling you at the beginning of the podcast. There are some good levels here. Now that we finally moved down, there's some things on sale and potentially coming to some important levels. INDA, India. Okay, this is a short. Up here in this blue area right here, this is what I'm looking for. Why? Well, we had a high here. We had a pullback. We made a higher high. Then we broke strongly to the downside. This changed structure to the downside. Therefore, if we get back up here, if we get back up to 52.24, I will consider getting short. Where's my stop? Just taking out this high here. That's all there is to it. I mean, if I get short here at 52.24 and the stop is 52.46, that's not a lot. What is that, 20, 30 cents? It's not much. Of course, I'll have my 2 ATR emergency stop here in case it just blasts off. But we change market structure to the downside substantially. So if we come back up, again, I'm considering getting short if we get to 52.54. Let's look at the weekly time frame and see if there's anything there. There's a lot there. Look at this high. Look how strong these green MACD bars are. See how we pull back? And now we're coming back up to challenge in these highs. Look, no green bars whatsoever. This is called a double top with a bearish divergence. This is showing that we are running out of buying momentum. And if you run out of buying momentum, the implication is you're going down. All right. So again, I'm looking for a potential short if we get up to at least 52.24. Intel. Well, Intel has really taken it on the chin. Look at this move down. My gosh, will it ever stop? I don't know, but there are some levels down here that are interesting to me. We got to the 200, that didn't hold. Next stop, 250-day moving average. Next stop, 300-day moving average. I've highlighted them here in blue. I drew a line here at the 250, drew a line here at the 300. How do those line up? They line up okay. This one's below the 50-day moving average, but it is lining up with this consolidation back here in the past. It is lining up with some of these highs that were resistance that we broke out of. And if you break out of a resistance, then that resistance becomes support. So this one's a little tricky. I really probably, before I would consider taking Intel, I'd really like to see a serious rejection of one of those moving averages. We're at 32.89, so rejection of the 30 RSI would also be great. Throw on top of that a V1 or a V2. That would give it extra bonus points. So I don't know how likely I am to take this unless I really have a perfect setup, because this really is weak. But I will watch the 250-day moving average for a rejection and the 300-day moving average. PayPal. Okay. PayPal is a potential short. Why? Well, same as INDA, we make a high, we make a higher high, we take this swing low out, which puts us into a bearish market structure. Again, the fair value gap I highlighted in the blue, the bottom of this bar, the top of this bar, anywhere in this area here is a fair value gap. And if my premise of that we've changed to a bearish market structure is correct, the correct thing to do in bearish market structures is to short rallies. So I am looking for a move up. I mean, right here, I could short it right here. Totally legitimate. But I'm looking for a test of the top of this fair value gap here of, what's that price? About 66.40. My stop will just be if we make a new high. That will change market structure to the upside again. And of course, I will place my 2 ATR stop way above here. It doesn't mean I'm going to take the trade, right? I mean, here's 10 trades. I could have all of them could trigger next week. But it doesn't mean I'm going to take all of them. But this is just one that I'm considering if we do get up here for a short at 64.10. Tesla. Well, Tesla has really taken it on the chin, but we have a potential for a higher low V1 or V2. I've talked a lot today about return to value V1s, V2s, but what I'm looking for is a higher low V1, V2. Rules on this is, first of all, you need to close below the -1 ATR channel. You need to close below the value zone. Then you need to rally into the value zone. Then you need to pull back. And then you need to create a V2. Well, this is formatting for a V2, but this would only happen on Monday, by the way. Bar 1, bar 2. Bar 2 goes below the low of bar 1. Monday only. If we were to close above bar 1's close, which is 171.11, we would have a higher low V2. That's what I would consider. And if I did take the trade, then my stop would be a close below halfway of the washout bar. So this is only for Monday if we close above 171.11. And then last but not least is XLRE, real estate sector. Again, we're quite a long ways away from what I'm looking for here. But look, here we have the 300, we have the 200, and we have the 250-day moving average. This is a nice confluence of levels, and I drew the line here, so the green line, let's go to the weekly and see where that green line lines up, and it lines up, look at that, magically at the 50 SMA on the weekly. So there should be some support on the weekly at this level, at least some. So on the weekly, we have support. On the daily, we would also have confluences of signals with the major moving averages. So again, XLRE, I would consider here. We're going to have to go down quite a bit more, so I'll just be patient. If it doesn't get there, I don't take the trade. If it does get there, I consider. Why? Because there's major support levels on the daily, and those coincide with major support levels on the weekly as as well. So those are the dailies. Let's take a look at the potential weeklies. I only have 3 of those this week. And when I'm done with this, stick around because I am going to take a look at the NASDAQ and do a little analysis on the NASDAQ for you as well, because there's some really important things that happen. But let's finish up with the weeklies. Okay, Adobe. Adobe has really gotten hit here. We're at the 200-week moving average and the negative third ATR channel. I'm considering this as the 200, but you can see we never quite tested the 200 yet. So next week, yes, if it tests the 200, I would consider getting long at the 200. But my experience tells me that the better place to enter this, because of this huge down bar here, my experience tells me that the better place to look for a trade on ADBE, Adobe, for me, is down here at the 250-week moving average, which interestingly coincides with the 100-day moving average as well. Because if we get to this point, we'll be in the low 30 RSIs or possibly even at 30 RSI. At the same time, we're at a major moving average. So yes, next week, if we have a nice rejection of the 200-week moving average, I consider. What I'm really looking for is a move down. And based upon my thoughts on the NASDAQ, I think that's more likely to happen. I'll talk about that in a minute, but really looking next week for some kind of rejection of the 250-week moving average and the 30 RSI. Budweiser. Well, we talked about Budweiser on the daily, and there's also something on the weekly. And I do like when I have markets that have multiple signals, both on getting close to a multiple signal on the daily and the weekly. Why? Because multiple time frames it's showing something, right? I was talking about Budweiser on the daily. Look, 200-day is what I'm looking for. Let's look at the weekly. Magically, the 200-week is setting up there as well. So that's good. That's, it's more levels of support on multiple time frames. So next week, what I'm looking for here on the weekly is simply some kind of rejection of the 200-week moving average. Doesn't mean it has to be a positive trade, but it gives you a good level to structure your trade off. And then Tesla. I talked about Tesla potentially on the daily on Monday going up above 171 for a long, but if we continue down, which is definitely likely, the 300-day moving average down here, the orange line, would be a very interesting level. And, when you're looking at potential levels like the 300-week moving average, look back in the past and see if that level was supported. Well, look at this. Close under, close over the 300. Very good risk to reward ratio. You would have had a monster trade. So when you're looking at a moving average to potentially base a trade-off, look in the past and see if that moving average was respected. It certainly was respected here. Doesn't mean it has to be this time as well, but in my opinion, adds a little bit more credibility that the market is respecting that 300-week moving average. Okay. Like I mentioned, let's take a look at the Qs. And if you've been following my podcast over the past few weeks, I have been quite bearish on the market. And specifically, why? Well, you can see, obviously, this market's been going up and up and up and up. But from a MACD perspective, we make a high, we have green MACD bars. We make another high, we have green MACD bars, but they are not as high. We make another high, we have green MACD bars, they're even lower. Then we make another high, no green MACD bars. So we're going up and up and up and up, and the momentum from a MACD perspective is going down and down and down and down. It just means you're running out of buyers. ATRs, here are the ATR channel, 3rd, 4th, 5th, 6th. Here we're up above almost to the 5th. Even though we're higher, now we're only at the 3rd. Now we're higher, we're below the 3rd. Now we're higher, we're even below that. Now we're higher, we're only to the 2nd. This is called an ATR divergence. So we have MACD divergences, we have ATR divergences, we have RSI divergences. Look at the RSI level here. As we go higher and higher and higher, the RSI goes lower and lower and lower. This is why I was really so bearish on the market. And then on Thursday, we had the huge crackdown. So are we at a level to buy yet? I don't think so. Look at the trend line here as I connect these bottoms. Okay. Well, on Thursday, we strongly closed below the trend line. Friday, we tried to get above this trend line, but it was too much, and we closed below it. So in my opinion, I could be wrong. I'm wrong all the time, but in my opinion, I still think we have some downside coming. So please be very, very careful. What I would look for at this point is at least some sideways motion and then a higher low V1 to maybe have another leg up, or we have to be open to the idea that we're going to head down lower, maybe down to this negative third ATR channel, maybe down to a 30 RSI. And a 30 RSI, well, that's where I would be interested in getting long the markets again. So as I mentioned at the beginning, I do teach private one-on-one lessons in the evening time via Skype. I teach a 15-hour course, one-on-one. Best way to learn is one-on-one with your instructor. The sessions are 3 hours each. I teach 5 of them, so you get a total of 15 complete hours. I teach all the trading strategies that I use. I teach you them step by step. And then once I've taught you them, then you basically have to teach them back to me, and we go through so many different markets, different time frames, and you need to show me that you understand and know the rules to everything. If you don't, we just keep the lessons going. That's how it goes. The cost of the course is $1,750. It's a really great value for what you learn and the experience that I'm going to share with you. And when you're done, you're going to be a better trader. I promise you. Again, I talked about the Udemy course that I have, extremely affordable and great if you're not in the financial position to take the one-on-one course. Just check out my link, Udemy, the udemy.com link in the description of this video. I know starting with that course, really a good idea, because you are going to learn a lot. If you like today's podcast, I really would appreciate it if you could hit the thumbs up button. Helps to build the channel, really does help out the channel, and it just takes one quick second. So if you learned something of value today, if you could hit the thumbs up button, I'd appreciate it. And as always, I always like to leave you off with, please try to go out and do something nice for someone today. Do something nice for an animal, do something nice for a human. If we all did one nice thing for a human and an animal each day, really this world would be a better place. And I think this world could definitely use that. So appreciate you being here. If you have any comments or questions, please leave them in the comment section. I'll do my best to reply to them as soon as possible. And God willing, if I'm around next week, we will do the podcast again and we'll take a look. But please be careful, everyone. I think the market sentiment has changed. Technically, it's changed. There's some geopolitical issues going on as well. So please be careful out there. Follow your process as always. All right. And on the way out here, I have to run the US Signal disclaimer. Thanks again, everyone. Have a great weekend. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security or product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.